Hello. Welcome back to our next video in building tax-free assets. Again, Whitney Emanuela here with Whitney Wealth Group. Today, we're going to be talking about health savings accounts, and keep in mind that these contribution limits are for 2023. So if you're not watching this in the year 2023, the limits based on income and the contributions may have changed. So welcome back. So we're going to be leaning in more into the health savings account than the flexible savings account, or FSA, because there's an investment component and it's a lot more flexible. However, you should know that an FSA, or flexible savings account, is where a lot of people qualify because they don't have a high deductible health insurance plan. So this is a plan that's tied to your health insurance. It's for health care expenses. And within flexible, you cannot do a health savings account contribution, however, if you have a low deductible plan. So a flexible savings account, the most that you can contribute to that is $3,050, and you get a deduction when you contribute the money to the FSA. However, you have to use the money that you put into that flexible savings account that year. You can't carry the money over. That's a key distinction between a FSA and a health savings account, or an HSA. So just remember that. But when you put the money in, you get a tax deduction. And then when you take the money out, it's tax-free. So you get actually a tax benefit on both the contribution and the withdrawal for healthcare expenses, which is really such a fantastic benefit. We generally recommend this for all of our clients if they have access to this plan. And so assuming that you use it towards health care expenses, they have to be qualified. So keep that in mind. Now, an HSA, or health savings account, is fantastic. We almost always recommend them for our clients who have high deductible health insurance plans. So if you use that, the maximum amount that you can contribute is $3,850. And then if you have a dependent or a spouse or family members that are covered, you can do $7,750. So again, like the FSA, you get a deduction on the front end, so you don't have to pay taxes on the contribution. Then it grows tax deferred, and you can invest this money. So when you invest the money, it grows just like a Roth IRA or any other investment account that would grow, depending upon what your investment options are within that account. And then when you use that for healthcare expenses, it's tax-free. Both Roth accounts and HSAs have potential for tax-free growth. But an added layer of benefit is the fact that you get a deduction on the front end with an HSA, unlike the Roth. So you reduce your income when you contribute, and then you don't pay the taxes on the back end. That's huge. It's never taxed if used for healthcare. At age 65, you're able to access all of that growth from the HSA plan tax-free. You don't have to use it in the year that you contribute, so you can accumulate a large amount of tax-free wealth in an HSA plan. We love them. For our clients, we recommend them often, like I mentioned before, if you're participating in a high deductible plan. There are times we'll talk with someone and they're participating in a lower deductible plan, and it makes more sense financially for that year, or generally speaking, for them to do an FSA. And the reason for that, it could be they have ongoing healthcare expenses, so they need more coverage. Perhaps they're planning to have children. There are a lot of different factors to consider between the two. But you, like I said, FSA, you have to use it that year. HSA, you can move it over to future years. Huge benefit. Again, we recommend them often. And next time we'll be talking about municipal bonds, which is another tax-free way to grow wealth. So we look forward to discussing that with you next video. Thank you so much, and blessings.